Dividends, that sweet passive income that companies pay to their shareholders. In this video, I'm going to talk about some of the issues with a dividend investing strategy. Let's check it out. Now, the first thing that I wanted to talk about is that idea of building a stream of passive income. A lot of big YouTubers in the dividend community talk about building a stream of passive income, which is basically their way of saying that if they dollar cost average or if they invest constantly in dividend stocks, then that passive income is going to grow over time and they're building that stream of passive income. However, I think it's important to consider the following thing. Let's say that you need $1 million for retirement, right? To make it easy. So you're just trying to get initially from $0 to $1 million. Now, it doesn't really matter how you get there. It doesn't really matter whether you're using a dividend strategy or whether you're investing in growth stocks. Really, at the end of the day, the only thing that's important is what type of vehicle is going to get you there faster. Because once you have, let's say, $1 million, you can then purchase whatever type of companies you want for your retirement. If you want, you can purchase dividend companies. If you want, you can buy real estate to have passive income. So it doesn't really matter. Once you have that $1 million, then you're set. Now, one of the issues that I see with a dividend investing strategy is that usually the companies that pay out dividends are already mature, established companies. They already have a high market share. It's usually less likely for them to grow at an accelerated pace. So if you think of the classical dividend companies like, let's say, AT&T or ExxonMobil or Chevron, whatever, usually these companies, not only are they not growing, they are usually on a downward trajectory. Now, granted, there are companies that still do pay dividends and are still growing, like companies like Home Depot, companies like Walmart, certain health companies. But the thing is, these companies are not going to explode. You're not really going to see them triple, like say in 2 years. Whereas with a growth stock, you do have a higher likelihood of that happening. Now, another issue that I have with dividend investing companies is that all of these companies pay dividend to their shareholders from their profits. Now, that's pretty sweet if you're already a shareholder and you're retired. But the thing to consider is that if you're not retired yet, then this profit is really coming out of money that could be reinvested in the growth of the company. So basically what this company that's giving you the dividend is saying is that we have no use to reinvest this dividend in growing our company. We just want to pay you back as a shareholder, which, like I said, is nice if you're already retired. But if you have a long-term perspective, then I would rather that my company invests in growth, invests in research and development to make sure that they have the best chance of succeeding and growing at an accelerated pace, rather than paying a huge portion of their profits to me as their shareholder. Now, another thing that the dividend proponents will point out is the idea of dividend compounding. So basically that means is that if you buy a company today and it's paying a dividend of, let's say, $1, usually these dividend companies are going to slightly increase their dividend year over year. So you might get from that same share, if the company increases its dividend, like let's say in 10 years, you could have a $2 dividend from that share. However, you have to consider the following thing. Even if you're buying a growth company, you're still taking advantage of compounding. It's just not compounding via dividends. So if that growth company that you are purchasing today is going to be 10x the price, let's say in 10 years, and then from year 10 to year 11, it doubles in price. Well, for you, if you think about your purchase 10 years back, the company not only doubled, you got yourself a 2000% profit on cost. So to conclude, do I think that you should avoid dividend stocks altogether? Not necessarily. I think that usually you should be on the lookout for the payout ratio. Usually the lower the better. Unless we're talking REITs, then you really want to look at a payout ratio of less than 30 or 40%, which means that they're really reinvesting at least most of their profits towards growing the company. Anywho, that was all I had for today. If you liked the video, please click the like button. Feel free to subscribe to see more content like this in the future. Thank you guys so much for watching, and I'll see you in the next one. Bye bye.